Good afternoon. This is Jim Boston here, and my friend Derek Malley. We're with Guarantee Rate Mortgage here in Chicago. We're going to talk today about three big myths that are being spread by the media. The first one I'm going to pass off to Derek is that people want to wait for interest rates to drop before buying. What do you think about that, Derek?
Thanks, Jim. That's something we hear all the time from consumers, right? Hey, let's wait to see what the election brings. Let's wait till next spring. Constantly, we're trying to wait for interest rates to drop, right?
Right.
And let's call it what it is. Everyone anticipates interest rates to drop in the next 1 to 2 years, determining the Fed's fiscal policy with rate cuts, with what's going on in inflation and employment. We're not seeing those rate cuts happen anytime soon, right? So the idea of waiting for interest rates to come down, in fact, could actually become a little bit more expensive for consumers. Now, why that is for a number of reasons, right? But many of consumers as of late have been sidelined just doing the same exact thing, right? So we have statistics here that if 1% interest rate drops, that's going to open the door for at least 3 million buyers out there who have been sidelined waiting for interest rates.
Pent-up demand, right?
Supply and demand, right? It's a common thing we used to learn in econ back in college, right? So with that said, the other things that people are gonna run into if and when they're deciding to wait for interest rates to drop is the competition. And all that pent up demand being back up and out there is gonna allow for purchase prices to just go up, 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 and up. So yeah, the idea of waiting for interest rates to drop sounds good theoretically, but what people don't factor in is all those other things that could happen if and when interest rates drop down, making it even more expensive for them to buy.
And I was going to say, in regards to multiple offers, even with rates being over 7% right now, we're seeing up to 20 offers on houses. So you can't imagine if they drop even 1% and they go down to like 6, what you're going to see in the marketplace.
Exactly. I mean, what was 550 with a 7% interest rate, once we're back down to 6%, is going to be nearing 600,000. Right? Because again, the number of people that are going to be interested in houses like this are going to do nothing but drive up the value. Right? Yep. So again, yeah, do we want to wait for interest rates to drop? Yeah, it sounds great. But ultimately, waiting is going to cost you more money.
Yep.
All right, the second myth I wanted to cover, Jim, and whenever you got a minute, let's cover this one, is owning is more expensive than renting.
Yeah, so that's another common misconception, that because property taxes and homeowners insurance, cost of owning is going up at a fast pace, but it's not going up faster than rents. Average rents are going up at maybe 2 to 10% right now, depending on the city in the country, but that's kind of the U.S. national average at this point. The other thing to consider is when property taxes go up, when insurance goes up, and even when interest rates go up, when the landlord's total principal, interest, tax, insurance payment goes up, who do you think they're going to pass that on to? They're going to pass that on to the tenant. So rents are going to go up. So regardless of how much those numbers rise, rents are going to proportionally rise as well.
Yeah, it seems to be a lot more expensive to rent than buy, and that's just from a financial perspective, yeah. Right? Let's talk about a couple of other things like pride of ownership, right?
Yeah.
If you rent, you can't make any changes without talking to the landlord or talking to the company first, right? If you want to make a renovation or a fix or a repair, you need to wait for your landlord's individual to get there, which in some instances, especially in this market, could take a number of weeks, right? So not only is it cheaper in some instances to buy, or at least more financially responsible, but you have a lot more control as well too, right? And then last but not least, especially when we're comparing renting to buying, we always want to look at building equity, right? If you have the same if you have the same mortgage payment that you do a rent payment, you're not going to be spending more money one way or another, but right. Only in one of those instances are you actually building equity, right? So again, there's a whole number of reasons why renting may not be as financially sound as buying. There's always the one-off, and we're going to get into that a little bit later as well, too. But when you look at building equity, pride of ownership, and just the sheer financial cost of it,
yep.
Owning is always going to be a better decision.
It is.
Right?
It is.
Except the one instance that we're going to talk about a little later.
Yeah, we'll talk about that later.
Right? We shouldn't wait for interest rates to drop. Buying is always going to be better than renting. So then the last, or I guess one of the other myths that I'm constantly hearing is this housing market's going to crash, right? And I think a lot of people oftentimes are a little bit more too cognizant of what had happened in the past, you know, maybe bringing up the nightmares of 2008, 2009, whatever it may be. But from everything that I'm reading, hearing, and seeing in the marketplace, real estate is typically one of the smartest, strongest, soundest investments to make, right?
Yep.
So if you could elaborate a little bit more on why this is a myth, what we could debunk, or what kind of information would be helpful for people.
Yeah, absolutely. So we've got to talk first about what caused the 2008, 2009 housing crash. It was mortgage delinquencies. A lot of bad mortgages were given out. This was back in the subprime days. So it was basically, the test was like, as long as you can fog a mirror, you can get a mortgage, basically. Back in the day.
If you had like a beating heart, basically.
Yeah, you could get a mortgage.
Right, yeah.
So all those loans went bad. Millions of people lost their homes to foreclosure. That's why the prices dropped, because there's a huge supply on the market, not a lot of demand, so the prices came down. Today, mortgage delinquencies are at an all-time low. So you're not going to see a huge influx of supply. So it is impossible, literally, for there to be a housing crash anytime soon, like at least in the next couple of years.
Yeah, and especially, like, to chime in here a little bit, like, I was always astounded by the amount of work that wasn't done to get a home loan back then.
Yeah.
You know, like, we're talking handwritten loan applications, no credit checks. Fraud. We're not even looking at people's bank accounts or pay stubs. Now, if you want to get a home loan, we're collecting everything but a blood sample. We're pulling your credit. We're going to even reach out to your employer to make sure that the income that you're telling us that you make, you're actually making, right? So a lot of the regulations, or I guess steps that the lending world, that the lending process has taken on, I think has almost deterred those types of collapses or busts.
Yeah.
Right. So we have our three myths, right? First and foremost, I'm going to wait for interest rates to decline. Again, just to kind of summarize, we don't necessarily love that as a myth, because again, we've kind of talked you through some of the math. Yeah, you can wait for interest rates to be 6%. You could wait for them to drop, but you're going to be joining a whole group of ton of consumers out there who are doing just the same. And like we had elaborated on, that's going to do nothing but cost more for you.
Well, and to add to what you're saying, yeah, you can wait for the 6%, but lock in your home price now, right? And then refinance when it's 6%. That's where the waiting is. The waiting is to refinance, because the mortgage you take out today is not the mortgage you're going to have forever. It's not the payment you're going to have forever.
I'm glad you said that, because right now, whenever I'm talking with consumers, I tell them to look at this as if it's a short-term product.
Absolutely.
We're using this as a vehicle to get you into the loan.
And lock in your price.
We're going to lock in your price, and we're going to refinance later down the road. Yeah. It's almost daily I tell someone, hey, we can refinance your interest rate. We cannot refinance your purchase price. You know, so
Very
again,
well said.
Yeah, right.
Well said.
That's something that I always tell people, because again, it really kind of hits home that, yeah, this house is going to cost more with more competition or demand out there. Renting is always going to be a little bit more expensive than buying. Okay. The one instance where we see renting being a little bit more advantageous than buying is if you're only going to be there for a short amount of time. You know, call it 1 to 2 years. Yeah, I would suggest renting at that time. Why? Because you're going to be incurring costs, right? You incur costs when you purchase a home. And if you're going to be living there, building equity, we really want to see you there longer than 2 years in order to make purchasing more advantageous.
4% appreciation is the number. If you go back 84 years is the statistic in the United States. Each year, the average increase appreciation is about 4%. So that's what Derek was saying. We want to see about 3 years or more for you to really benefit from owning.
Exactly. And then our third myth: housing market's going to crash. Tell that to people who bought 2 years ago that got 20% equity in their house built up.
Yeah.
Right. I mean, if you stand sidelined waiting for it to be a perfect time to buy, chances are you're going to be on the sideline for a really, really long time.
Well, and I want to get into too with respect to that is the average amount of equity that the U.S. homeowner has is more than 50% right now.
Isn't that nuts?
Which is staggering. So
talking about this is one thing, but have you ever ran into any of this in the real world as you're out and about there looking at mortgages for clients?
Yeah, all the time. In fact, I'm going to give you a specific example of one that's fresh in my mind just from a couple of weeks ago. These clients in the West Loop, where I also live, they had a baby on the way, 2-year-old kid. So growing family, they're living in a 2-bedroom apartment. They got to go bigger, right? So and they want to live in the city for about another 5 years. That's their time horizon. Yep. So they sat down with me for a consult just to ask whether they think it's better to rent in the city for another 5 years or to buy. Mm-hmm. I calculated their affordability first. So $700,000 was about the price range that we looked at. And if they were going to rent, they would also rent a condo that was in the $700,000 range. So we looked apples to apples, renting versus buying. We looked at first the cash flow analysis. So after the third year, as we were talking about before, the first 2 years, it's better to rent. Starting in year 3, that their cash flow, they started to benefit. So their total monthly payments were lower than renting starting in year 3. So that was the cash flow side of it. Then we looked at the amortization side, when as far as how much they're paying the mortgage down each month in principal. And then we took into the account the appreciation over 4 years. Or over 5 years, sorry. So appreciation was about 4% a year. So we ran all that into the calculation, and we ended up coming up with a number. All those three added together, $171,000 over 5 years is how much they're going to be ahead, versus if they rent. If they rent for 5 years, they're going to come out with nothing at the very end. So, and this is not even accounting for any of the income tax advantages that you might get. I'm leaving that out completely. I was also fair, and I calculated the closing costs to both buy and sell in that time period. So I included realtor commissions on both sides, counted all of that against them, and that's this $171,000 I just gave you. That's already factored in. So that's their total net gain over the course of 5 years for owning versus renting in the West Loop.
So you were able to kind of illustrate with this client that over 5 years, if they were going to rent a place for $700,000 or likewise place for $700,000 yep. or buy a place for $700,000, at the end of that 5 years, if they were to own, they'd be ahead $171,000.
Yep. If they were to sell after 5 years, that's assuming they sold. So that number is obviously going to keep growing if they stayed longer.
And just out of curiosity, what were you using for the interest rate?
I was using a rate of 7.5%, so I was being aggressive. So that's also assuming, I'm glad you brought that up, that's assuming that they don't refinance at all in that 5 years. We almost know for certain that they're going to refinance in the next 2 years. So it's good. That number is going to be much higher.
So I'm sure that they were a little turned off once they saw 7.5 on the interest
rate. They
were
almost like, they wanted to walk out of the office.
They wanted to go buy, right? They wanted to go rent.
I'm like, hold on a second, I gotta show you.
But then once you do all this and say, at 7.5, you're still going to be out or ahead $171,000 in 5 years.
Because I wanted to be ultra conservative. I wanted to say, let's say the shit hits the fan and rates are just terrible for the next 5 years, and you're stuck at 7.5. You don't refinance.
Yeah.
Let's look at it worst case.
I mean, nearly $20K a year.
Yeah. And
that's not even factoring in all the money they'd waste at rent, or is that factoring it in?
That's that's all factored in.
Gotcha.
Yeah, and then if you rent, you just have nothing to show for it.
Nothing to show for it.
Yeah.
And I mean, you could even do that on a smaller scale, right? So I mean, even if you have someone who is at $350,000, they're looking at what, approximately $85,000.
Yep.
In savings or I guess in gains over the next several years.
Yep.
So whenever we go through these examples, or whenever we're talking about the benefits of buying, I know from a consumer's perspective, it's easy to say, well, you guys work in the industry, right? You benefit from people buying, and I get that.
Yeah.
Obviously I want people
You got to
to
be skeptical. Well, you got to be skeptical if you don't work in any particular industry, listening to a podcast of two people talking about it. You want to know where they get their information from, their source.
And we certainly do want clients too.
Yeah.
Right. But with that said, all this information that we're going through, all these numbers that we're talking about, this has all been sourced, and a lot of the sourcing that we do is coming from MBS Highway, okay, which a lot of the industry people know. We follow Barry Habib, okay. I say that if anyone has a crystal ball, it's him. When people typically ask me what I think interest rates are doing, I usually tell them if I had an exact, direction for you, I'd probably be on a beach. I wouldn't be doing mortgages, right?
You'd be in the Bahamas.
I'd be in the Bahamas, you know. But again, all this stuff is sourced from MBS Highway, a source that we use for a lot of this. And I want to say that they're even going to the Fed with a lot of their information, correct?
Well, in fact, Barry Habib is who advised the Fed on how to handle, during COVID, how to handle all the emergency payments to people that were suffering hardships that lost their job. I mean, nobody's perfect. Nobody can predict everything exact, but he has won several awards, one of them being called a Crystal Ball Award. Literally.
Does he really?
Literally. This is by like the economists, different associations, just for accurately predicting housing market and mortgage trends. So this is about as reliable as it gets where we're getting our information and data. And that's also where the calculator that I use to advise clients, where I get that from in the example that I just gave you.
With all that said, you know, myself and Jim here, we're a little bit of dorks when it comes to the mortgage industry. So we could talk about this stuff all day, right?
We could.
But ultimately, what the motivation to do this was, I know Jim and I, whenever we're watching the news, we're just astounded by all the BS that's out there.
So much crap being spread by the media, and we want to debunk it.
Whether it's trying to lead you one direction, trying to scare you, whatever it may be, you know, when we're out and about in the field, living, working, and doing this day to day, it gets a little irritating to see some of that out there. So I think the whole point of this today was to go over what we've been seeing, talk a little bit about why we think it's, for lack of a better term, bullshit, and make sure that we can give some value to consumers and agents out there.
Yeah, and one thing I like to tell everybody is that the media fears what sells, and that's what the media has to sell. The truth does not sell, and that's why that's not what they're telling, and that's what we're here for today, to help educate you so you can make the right decisions.
So with that said, we're going to leave our contact information below. Please feel free to reach out to us with any questions. If you have anything to walk through, we're here to help.